If you held crypto in 2025 and your 1099 DA showed up this month, I need you to pause right here. And bulletproof next year's filing against the stricter brokered basis reporting kicking in on January 1st. So if this is the level of detail you want weekly, tax strategy, wealth positioning, the stuff most creators won't touch, I send out free newsletter every week at empowercapital.co. Links in the description. Let's get to it. All right. So stay with me, because by the end, I'm going to tell you about the one hype, right? The one type of crypto transaction that isn't on your 1099 DA at all, and why that's either the biggest landmine or the biggest opportunity, depending on how you handle it. Most people miss it entirely. So here's what actually happened. IRS rolled out the 1099 DA. DA stands for digital assets. As part of the final broker regulations finalized in 2024, starting for tax year 2025. The return, right? You either filed 2 days ago, or you're still extended. Every centralized broker that served the U.S. customers was required to file one. Coinbase, Kraken, Gemini, Binance, U.S. Robinhood Crypto, PayPal, every one of them. Now, here's a trap. For 2025, brokers are only required to report gross proceeds. Cost basis reporting is optional, and it becomes mandatory in January 1st, 2026, meaning next year's 1099 DA will include it, but this year's largely does not. Let me translate what that means for your audit risk, because that gap, right? Gross proceeds reported, cost basis blank, is not natural. Okay, it's not neutral. The IRS's automated underreporter program doesn't read the blank as basis to be determined. It reads the blank as zero. Okay, as in you sold 280,000 of crypto and IRS has $280,000 of proceeds on file. Your return says the gain was 40,000 and the machine flags a $240,000 discrepancy. And that's the CP2000. That's the $37,420 problem. Let me walk you through the exact math, because I want this specific, right? I want this specific. Because say you're our typical high income filer, married filing, $380,000 ordinary income, putting you in the 23% bracket for long-term capital gains. Once you stack up the 3.8, the investment, that investment tax, 20% long-term capital gains, right? So 23.8. You sold a mix of BTC. It's in 2025. Total gross proceeds 280K, right? Your actual basis, right? What you paid for those points across 2017 to 2023 is 240,000. Real long-term gain 40,000. Tax you owe 9,520. But the IRS is matching it as an engine sees 280K proceeds with no reported basis. If they assert zero, right, basis, which happens far more than often, most investors realize they're going to propose additional tax of $66,000, right, on top of that $280,000, plus interest, plus penalty on top of all the underpayment penalty if you can't substantiate, right? So that's another $11,424. Now, in practice, most filers can partially reconstruct bases, right? Exchange exports from the platform still operating old tax lots exports, maybe, but let's say you can defend 60% of the basis solidly, right? What's left, right? 40% of that, you still left with a lot to defend, right? So plus roughly 10% of accrued interest and appliance costs. By the time the matter closes, it adds up. You're staring at $37,420 of cost you do not actually owe. That's the number. That's the consequence of letting the 1098 go out the door without bulletproof documentation behind every single line. So now look, I've seen clients hit, right, with bigger numbers, right? 6 figures is not rare, right? Once you layer in DeFi, staking, and swaps that the broker didn't see, right? It compounds. $37,420 is the median exposure I'm watching roll across my desk right now. That's the realistic scenario for a typical high net worth holder. So the natural question is, Samuel, right? Can't I just file an amended return showing basis? The answer is yes, and that's step 4. But we have to get step 1, 2, and 3 right first, or the amended return confirms the IRS's adjustment instead of reversing it. Let me explain what changed. So let's talk about the per wallet rule killed the universal method, right? This is the part where most crypto investors I talk to, right, don't even know the ground shifted under them. Before January 1st, 2025, the IRS tolerated, right, what's called the universal method for tracking crypto cost basis. The universal method let you treat every coin of a given asset, every BTC, every ETH, as one combined pool across every wallet you own. You picked your accounting method, FIFO, specific identification, HIFO, right? And you applied it across your entire holdings as if it were one big account. The approach is dead as of January 1st, 2025, based on 2024 regulation, right? Formalize the transition rule and the final broker reg codification requirement. The IRS now requires cost basis to be tracked on a per wallet or per account basis. Every wallet, every exchange account, every cold storage device, each is its own silo for basis purposes. And here's the part nobody's talking about, okay? Nobody's talking about, okay? Nobody's going to tell you clearly. Your 22 records one that your software spits out using the universal method for prior years do not automatically translate into a compliant per wallet snapshot for 2025. You want to make a reasonable allocation for prior year unbiased basis to each wallet as of January 2025. Most people don't know that, right? Okay. So let me give you the concrete example. You hold 5 BTC across 3 wallets, 2 on Coinbase, 2 on Kraken, 1 in a ledger code storage. Prior to 2025, you track them as one pool, average basis across the 5, 28,000 per BTC. In 2025, you sell 1 BTC on Coinbase. Your software, still thinking the universal method, tells you the basis is $28,000, but on Coinbase's internal records, the 2 BTC sitting in that specific account have an average basis of 52,000 per coin, because those were the ones you bought in the 2021 bull run. The 3 BTC you bought in 2027 to 2017 to 2018 at 7,000 were deposited at the Kraken wallet. Your return says gain is 0 on a $52,000 sale. Coinbase's 1098 started in 2026 will say gain is negative 21,000. The matching engine sees the discrepancy and flags it, right? 2 returns with the same total gain, 1 compliant, 1 triggered an audit, and almost nobody has done the transition allocation correctly. Okay, so The fix is a safe harbor allocation, which you had until December 31st, 2025 to log in formally. I'm going to be blunt. If you miss that window, you're now in reasonable method territory, which still works out, but requires a documentation I'll walk you through in segment 4. We're about 13 minutes in, and I haven't even gotten to the CP2000 timeline or the 3-step fix. Stay with me. This is where it becomes actionable. Also, remember that thing I said at the start about one type of crypto transaction that isn't on your 1099-D at all. Keep that in the back of your head. I'll close that loop in segment 5, and it's going to change how you think about next year's fire. So let me demystify the notice you're about to receive. If you're in the crosshairs, right, here's the schedule. The IRS runs it automated under reporter matching paths between July and October for the prior tax year. For 2025 returns filed now, the first CP2000 notices will hit mailboxes between August 2026 and January 2027. Peak volume would be October 2026. What does a CP2000 look like? It's not an audit. I want to be clear about this because people panic. It's a proposed change to your return. The notice will say something like, based on the information received from a third party, we propose the following changes. Additional tax owed, $557,120. Please respond within 30 days. You do not simply play it, you respond. You have 30 days from the date on the notice, not when you got it, to agree, disagree, or partially disagree. If you don't respond, the IRS issues a statutory notice of deficiency, the 90-day letter, which locks you into a tax court of payment. That's the one you cannot ignore. So here's what most people do wrong. They open the CP, they see the 57,000. Oh, did they panic? They either pay it or they call the CPA or EA or tax attorney on Monday morning after sitting with it all weekend. By Monday, the clock already ate 2 days. And because most CPAs and EAs and attorneys don't touch crypto, either overcharge or they punt. If you are an EA supported filer, which is what I recommend for anybody with a serious crypto position, and no agent has standing to represent you in front of the IRS on this notice without further power of attorney letter gain. That matters because time is the whole asset here. Every day you spend finding a practitioner is a day off the 30-day clock, and you'll anchor you, all right? And to anchor you again, the 37,420 number I gave you is what you end up paying after a competent response knocks down most, but not all of the IRS adjustment. If you don't respond competently or you don't respond at all, you're looking at the full 57,000 plus interest, right? Penalties. That's the distance between good response and a bad one. We're 18 minutes in, still 2 full segments to go. The 5th fix starts now. So here's what I do for clients and what you can, all right, what you can adapt on your own this weekend if you're self-fighting. Step 1, reconstruct per wallet basis for every disposition in 2025. Pull your complete transaction history from every exchange you used, everyone. Including everyone, including the ones you stopped using. Coinbase lets you export. Kraken lets you export. Gemini has a ledger pool, right? Even defunct platforms will respond to CSV requests if you open a ticket. For cold storage, you're going to walk the wallet address on a block explorer. Match the transaction hashes to your bank or bank equivalent records and reconstruct acquisition cost in USD using the exchange rate on the acquisition date. This is tedious, okay? It's not hard. Budget 4 to 6 hours if your activity is on 200 transactions for the year, more if you were active in DeFi. Label every basis number with its source. Coinbase exports line 412, Etherscan, TX hash, blah, 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 right? This is your evidence file. I cannot overstate how much weight a clean evidence file carries when you're in front of the IRS examiner. Step 2, file a qualified amendment or a preemptive statement with your return. If you already filed, you have options. You can file Form 1040X with the revised Schedule D and Form 8949 showing basis fully documented. Attach a statement on the penalty for perjury that lays out your per wallet allocation and the reasonable method you use, right? If you missed the safe harbor window. If you extend, you have until October 15th to file with this already built in. Do not treat the extension as 6 more months of procrastination. Right? Treat it as 6 more months to build a bulletproof return. Okay. And a note on the software. I like Coinly, CoinLedger, Kivax, right? Token Tax, right? They're good, but every single one of them has a setting called lot matching method that most users never touch. If you check Universal in the 2025 setting, you are non-compliant, right? Out of the gate, regardless of how clean your data is. Change it to per wallet, then rerun the report. Step 3, respond fast when the notice arrives and respond in writing with evidence attached. Okay. So when the CB2000 comes, your response is a 2-page letter plus exhibit. Page 1, a plain English recap of what the IRS proposed, what your actual position is, and the specific dollar adjustment you are requesting. For our hypothetical, the IRS proposes $57,000, 120 of additional tax. I agree with 0 of this adjustment. My actual long-term capital gains for 2025 was 40,000, on which I already paid 9,520 of tax. I'm providing full per wallet basis documentation as Exhibit A. So page 2, right? The legal basis for your position, citing the relevant IRC section. 6662 for accuracy related penalty position if relevant, and the broker basis report and regulation. Exhibit A, the evidence file you built in step 1. You submit via certified mail return receipt. Keep copies for everything. If you have an enrolled agent, they filed the response with their P10 attached, and they are now your representative of record for this matter. So that's how it goes. So do these 3 steps competently, and the $37,420 number goes to 0, near 0. Miss a step, especially step 1 on documentation, and you're paying part or all of it. And that's the difference. It's a weekend of work versus 5-figure check to Treasury. All right, you can save that money or give it to Uncle Sam. Up to you. All right, so let's move on. Let's talk about the 2026 strategy and the transaction that isn't on your 1099. Okay, I promise I'd close the loop from the start of the video. So here it goes. DeFi, wallet to wallet transfers, chain swaps, staking rewards, approvals, NFT mint and transfers. None of those will appear on your 1089 DA. Your 1089 DA is only what centralized brokers see. Everything that happens on chain, right, in your self-custody wallet, in a decentralized exchange, in a lending protocol, the IRS doesn't receive a form for any of it. That cuts 2 ways. The landmine, you're 100% responsible for tracking it yourself. There's no broker to fall back on, no third-party report that matches what you're reporting. Starting in 2026, the IRS is investing heavily in blockchain analytics, in analysis, TRM labs, and in in-house tools to match on-chain activity to taxpayer identities. If you had 80,000 of DeFi activity in 2025 and you didn't report it, the mismatch won't come through a 1089 DA. It'll come through blockchain forensics later. And the penalty regime for willful unreported is worse than for documentation gap. The opportunity, because on-chain activity isn't automatically reported, you have more flexibility in your cost-based documentation, your accounting method, and your tax law identification, as long as you document it properly. Well-documented DeFi position using specific identification can be significantly more tax efficient than an exchange position where the DA boxes you win, right? Or even HIFO is pretty good as well. If you combine step 1 through step 1 through step 3 from the segment 4 with discipline for wallet tracking for on-chain activity going forward, the 37,420 exposure from this year's mess becomes zero going forward, and you're positioned to save another 5 figures annually from optimized lot selection. Be sure to like, share, subscribe, comment if you have any questions, get this word out. And so that's basically how it goes.